We live in an economic system that runs on spending. So if I make $50,000 a year, I, in theory, can only spend 50,000, but now thanks to credit cards, lines of credit, maybe I can spend $100,000, which is good in the short term because that means I can go and buy more things today. But the problem is, like you're mentioning, that could hit a potential breaking point. And now what we're seeing is Americans are getting tapped out on their debt levels. People are maxing out credit cards. Delinquency rates are starting to rise. What does that mean then for the economy and spending in the future and businesses that are relying on this continuous rising spending?
Yeah, well, first of all, spending should not be what drives an economy. That's the inherent problem. We have a bubble. What should drive an economy is savings and production. So when you save money, the savings can be invested in productive assets, plant and equipment and things like that, to produce goods. And then once you produce goods, well, then you get to consume them, you get to spend. But America puts the cart before the horse. We want to spend first and not even produce, right? We want to just go buy stuff that we didn't even make. And so the only reason that we could do that is because the rest of the world is making the stuff that we're buying and lending us the money to do it. But that is an unsustainable economic model. And, right now, Americans are already leveraged up to the hilt and interest rates are still too low. And if interest rates went to where they needed to be, pretty much everybody would be broke, including the U.S. government. So I think the Fed is ultimately going to keep rates artificially low, and I think they're still too low. I mean, the Fed claims that the rates are restrictive. They're not. That's why inflation is accelerating. The rates are still too low, but if they raise them to an appropriate level, assuming they even know where that level is, I think, the debt ridden economy would implode with the weight of that debt service. So the Fed is kind of trapped between a rock and a hard place that it created, because the reason everybody has so much debt is because the Fed kept interest rates so low for so long. And so this is the obvious consequence. I've been warning about it for a long time, and now we're having to deal with the consequences.
So now when you talk about interest rates being so low, it's interesting that you say that, because obviously I would say most of America believes the opposite, that interest rates are way too high. I can't buy a home, I can't buy a car, I can't afford anything.
Well, that's too bad. But people have a short memory, and they're just comparing the rates we have now to the rates that we had for 10, 12 years, starting from the 2008 financial crisis until about 2022. So for most of those 14 years, rates were zero or very close to zero. And so Americans were able to borrow to buy homes at 3% and 4%. They were able to get ultra low auto loans. Credit was cheap and plentiful, and that's the problem. That's why we have so much inflation. But now rates are getting back to normal. They're not even high, but given how much debt we have and how big the inflation problem is, rates need to be more than just high. They need to be very high. But we're not even at high. We're kind of at a normal rate, a 5% rate, for an economy that has a normal rate of inflation. But we don't. We have very high inflation, even though it's pulled back a little bit from the peaks. That's just a temporary decline. The trajectory is much higher. And especially if you look at the forward-looking indicators, look at commodity prices, for example, they're soaring. So they weren't doing that last year, but they are this year. And so these big price increases are going to show up in the CPI later in the year, when the CPI is moving back towards 10%, not down towards 2%.
If you enjoyed this clip and you want to watch the entire conversation, all you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.